All right, let's jump straight into this explainer. We're going to break down the massive recent correction we've seen in gold prices. We're strictly looking at the hard data and the broader macroeconomic landscape here to answer one huge question. Is this historically steady asset fundamentally broken, or are we actually looking at a historic buying opportunity? Let's set the stage with the sheer scale of this drop, because it's a big one. Gold had this absolutely incredible run, right? It peaked at around $5,500 an ounce earlier this year. But recently, it tumbled back down closer to $4,000. That is a severe 26% drop from its all-time highs, and a move that drastic has definitely shaken up the market and left a whole lot of people wondering, what exactly comes next? So here is our roadmap for today. We're covering the big gold correction, zooming out to look at the 25-year performance, current headwinds for gold, asking is the thesis intact, seeing how central banks are buying, and finally, how to gain exposure.
Okay, Section 1, the big gold correction.
Now, whenever any asset suffers a significant correction like this, investors predictably split into two totally opposing psychological camps. You've got Group 1, the panic camp. They look at the recent chart and confidently declare gold is crashing, the whole rally is completely over. But then you've Group 2. They're looking at the exact same data, but their takeaway is, hey, gold is finally affordable again, I'm absolutely buying the dip. It really is a tale of two entirely different mindsets. And honestly, this just highlights a fundamental human flaw when it comes to investing. It's exactly like knowing you need to diet and exercise to get healthy. Conceptually, sure, everyone knows the golden rule, buy low and sell high. We all know that. But in reality, when that plate of junk food is right in front of you, or in this case, when fear takes over as prices drop 20–25%, it's incredibly hard to do the work. People say they want lower prices, but when the discount actually shows up, they immediately panic and assume something must be horribly wrong. Right, moving to Section 2, zooming out, 25-year performance. To see past all that emotional short-term panic, we really need to look at the hard historical data. Over the past 25 years, gold has actually doubled the performance of the S&P 500. Yeah, you heard that right. Even factoring in this recent 26% correction we just talked about, gold has grown an astounding 938% compared to the stock market's 461%. For a lot of folks, that is a highly surprising statistic. But, well, the data speaks for itself. The crucial takeaway here is that while this recent 12-month period has undeniably been super volatile, long-term bull markets are almost never just a straight line up. They naturally include sharp corrections. They go through these periods of consolidation that kind of shake out the weak hands. Just because you have to endure a steep, short-term decline doesn't automatically mean a massive, multi-decade structural trend has suddenly just died. Let's hit Section 3, current headwinds for gold. We do need to be objective, though, and examine exactly what forces dragged the price down from that $5,500 peak. The primary short-term headwinds suppressing gold right now are largely monetary. First off, we've got higher interest rate expectations, which have been forced by sticky, energy-driven inflation. Second, we're seeing surging treasury yields as a direct result of those rate expectations. And third, a consequently stronger U.S. dollar. Gold generally thrives in a low interest rate environment, so these three factors combined are acting like a heavy wet blanket on the asset's momentum right now. To put that headwind into perspective, check out this staggering number. The yield on the 30-year Treasury bond has skyrocketed to 5.11%. Just a few years ago, it was sitting at a measly 2%. Back then, nobody wanted to lock up their money for 2%, so holding gold made perfect sense. But at over 5%, that actively tempts investors to park their cash in government bonds instead of safe haven metals. That's a very real, very potent short-term negative. Okay, Section 4. Is the thesis intact? So, those monetary pressures are undeniably real, but we have to ask ourselves, have they actually broken the fundamental long-term reasons for owning gold in the first place? Let's do a rapid-fire reality check on our fiscal situation. Ask yourself, has the U.S. government stopped its deficit spending? Has the national debt finally started shrinking? Has the underlying structural issue actually been solved? The undeniable answer to all of that is a resounding no. Actually, it's quite the opposite. The U.S. government debt has now ballooned to a truly staggering $39.6 trillion. We are rapidly closing in on the $40 trillion mark. The core fiscal reality that originally made gold so attractive hasn't vanished at all. It's accelerated. And it goes deeper when you look at these compounding factors. Federal interest expenses are getting worse every single year. The global monetary system continues to completely lack foundational discipline, and all this ongoing money printing, it's pushed the M2 money supply to absolute record highs. The macroeconomic environment, the actual structural thesis for holding a hard asset like gold, remains completely 100% intact, regardless of what the spot price did last week. Which brings us to Section 5. Central banks are buying. If you want to know how the smart money is interpreting these fiscal realities, just look at global central banks. Over the last few years, China has been aggressively buying gold for 20 consecutive months, a streak that kicked off back in October of 2023. As global diversification ramped up through late 2025, China then capped off their streak with a massive 15-ton purchase in June 2026 alone. They are actively and aggressively diversifying away from fiat currency. And hey, it is not just China. Across the globe, central banks are collectively hoarding roughly 1,000 metric tons of gold every single year. They've maintained this blistering pace for the past 4 years, which is literally double the purchasing pace of the previous decade. Governments and central banks, they think in decades, right? Not in next month's price fluctuations. This really points to a stark modern macroeconomic reality. History shows us pretty clearly that no fiat currency survives forever without backing. So while the US dollar definitely remains the world's reserve currency for trade, central banks have quietly crowned gold as the world's undisputed reserve asset. They're using this time to build up their physical reserves, treating corrections not as a crash, but as a highly strategic entry point. Finally, Section 6. How to gain exposure. With the structural thesis fully intact, how can an everyday investor actually take advantage of this discount? First and foremost, you have to understand that nobody has a crystal ball. Trying to perfectly time the absolute bottom of this dip is just a fool's errand. It could bounce tomorrow or, it could fall another 10%. The smartest strategy for a logical long-term investor is to simply dollar cost average your way into your position. You already know you aren't buying at the absolute peak, so you can just comfortably and steadily accumulate over time. When it comes down to execution, there are 4 primary avenues to gain this exposure, and each one has its own specific pros and cons. You can buy physical metal if you want direct, tangible ownership. You can use stock market ETFs for ease and high liquidity. You can invest directly in gold mining companies, or you can purchase shares in specialized royalty and streaming companies. The right method depends entirely on your personal risk tolerance and your overall portfolio strategy. So, as we wrap up this explainer, I want to leave you with one absolutely crucial question to evaluate your own investing mindset. When you look at this 26% correction, are you letting fear drive an emotional reaction to a short-term dip? Or are you logically positioning yourself for the undeniable long-term macroeconomic reality that the smartest money in the world is currently preparing for? It's a question every single investor needs to answer for themselves. Thank you so much for joining me on this deep dive, and I highly encourage you to keep questioning the data.